There's clearly people want to look at the overall business and the valuation of an IPO, but I think there's some other factors that are not as obvious but just as important with IPOs to look at. And I think companies, one thing we look at really carefully with IPOs is the use of funds. So is the capital that they're raising from investors being used to expand their business, to, either organically or via buying a competitor or doing something to grow the business? Or is it just being used for something a bit more financial? Like, is it being used to pay down debt or buy out other shareholders and those sort of aspects? So I think the former, when that money is being used to actually expand the business, is a really good reason to look at an IPO. And I think for all those alternative reasons in terms of selling, paying down debt or paying off other shareholders, I think is actually a poor reason to be raising money. We've seen a number of examples like that. I mean, the most recent example has been the biggest IPO this year, which is Viva Energy. They did a couple of things. They had a range of pricing in which the IPO was done, so there was really no price tension in that. There was also a range of number of shares that were being sold down, and all the funds being raised were being used to pay down an existing shareholder. So not surprisingly, given there was no pricing tension, there was a excess of shares, and all that money was actually going out of the business, the shares just haven't performed well at all. In fact, I think last I looked, they were down about 5% in their IPO price. I think probably one of the IPOs that we have liked quite recently is sort of a high-tech business that's actually based in the US called Pivotal Systems. It's quite complex what they do. It is gas flow monitoring for the semiconductor industry, but they've got some very big clients. They've had some very strong revenue, and they've raised a significant amount of money, about $30 million. Now, some of that money has gone out to buy out existing shareholders, but the big VC backer, that's their major shareholders, kept all their shares in the business. So most of that money has actually gone for expansion capital to develop new products, to expand their business with their current client, blue chip client bases for the likes of Hitachi and such. So we think, it's got an exciting business with, quite strong growth, and with their capital that they've brought in from the market, we think it'll be a really kind of good near-term future for that business. Yeah, so I guess one of the other ones that's come on this year that's been moderately high profile has been Marley Spoon, which has been the online, I suppose, make your meal at home business. That is an interesting business in the fact that it's actually losing a lot of money, but it is a global business with a very, very strong customer base, but with a very high cost of customer acquisition. And there is some question over the scalability of that business and also its possible profitability. So that wasn't a business that we thought was terrible. We just thought that it was a business that was being very, had a big drain on cash flow, and we weren't convinced that even the money that they were raising, which I think was around $60 million in the market, was still quite enough to get them to profitability. And one likes to always think that if a business is going to raise money in the market, that is going to get them through to profitability, cash flow positivity, and hopefully dividend payments to their shareholders. And if you think it's just one step on a constant road of raising money, that's not something we really want to put money into initially. Since the complete Dick Smith nuclear explosion with that business really going out of business in a very short period of time, which was a private equity sell down, it's given that whole sector a really bad rap. Unfortunately, actually a lot of examples where sell downs by private equity have performed quite well. Anchorage sold down a stake in Motorcycle Holdings a couple of years ago, and that business has gone from strength to strength, and I think is trading up about 50% on where they originally sold down. But probably one of the greatest examples of recent times has been the float of Lovisa, where Brett Blundy was a large shareholder in that business and sold down half his stake. I think it was about 4 years ago, 3.5 years ago in Lovisa. And that stock's gone on, it's gone up 5 times since he sold down. So I think if investors had this broad brush approach that, it's a PE sell down, I don't want to be involved, I think sometimes they're going to be throwing the baby out with the bathwater. Again, you've really got to look at each business on its own merits. Clearly, if an investor's getting out completely, you do need to probably raise your eyebrows a little bit and think about whether that's the right thing to be doing. But broadly, I think if you take that approach, you need to be a bit more, a bit cleverer than just writing off all PE sell downs.